How to maximize your cash value. We are going to have fun with this video. We are going to look at a split study similar to the last couple of videos where we've got an individual. We're going to look at a 40-year-old male this time, not a 35-year-old individual, paying in $100K per year with a 15-pay policy with Guardian. A 15-pay policy with Guardian is an excellent choice. This is one of my favorites. Is it my most favorite with Guardian? I can't quite say that. I always go back and forth between their 15-pay L95, I'm a huge fan of, and then also their executive strategies whole life policy for larger cases. If it's a corporate sale or a high net worth individual that's paying in $1 million per year or more. But 15-pay and L95 are very similar, but I'm not going to talk about the product details in this video. What we're going to look at is this specifically. We're going to look at a split study similar to the last video or last videos, where we've got a 10/90 split, 50/50 split, and 100% base premium. This way we can specifically address that question. If I go with the higher base premium, will that result in more money long term? What we're going to look at in this case, in the past couple of videos, we isolated 10-pay policies. Here, we're going to use a 15-pay policy, but because it's with Guardian, we're going to optimize their sweet spot. We're going to fund for 7 years, right up to the MEC limit, and then stop. Specifically, we're going to look at a reduced paid up option, which will eliminate the base premium altogether and maximize cash value growth on both a guaranteed and non-guaranteed basis. So we've got a short pay in this example. Let's have some fun, shall we? So 10, 50/50, and 100% base premium. Before we look at the Excel sheets, actually, let's take a look and validate the design. What we'll begin with is the 100% base premium example. So where's the money going? That's always the question. 15-pay whole life, $100,000 base premium. So a 15-pay whole life, where it is a little different from a traditional whole life product or Guardian's L95, for example, is that the base premium, if I take a traditional L99, 95, or L121, the first year, goose egg in cash value, or very close to it, maybe a couple $100. With this, I get just over 15%, 15-pay, look at that. 15-pay equals 15%. It's closer to 17% in this example. But the 100K base premium, there it goes in, all premium. There's the cash value buildup based on the base alone. So there's no PUAs added to this particular example. I've got the guaranteed values, and the current values represent the present dividend interest rate, 5.65, and the guaranteed represents 3% gross guaranteed rate. All rates from insurance companies are gross. Intermediate is in between the two. So when I look at this, guaranteed and non-guaranteed, what do I see here? This is an all base premium policy, by the way. So nothing fancy at all. We'll see that in the next example. Next two examples. Based on the current dividend interest rate, there I go, year 9, I've broken even. Meaning you paid in $700,000 total, 100K for 7 years, and you have $700,000. How about the guarantees? Or actually, let's look at a conservative dividend. Year 12 is when you get your money back. Guarantees. Year 18, between years 17 and 18, when you recapture your $700,000. Okay, now we're going to compare the long-term results as well. Let's look at the 50/50. Here we go. So 50/50, where's your money going? There's my base premium. $50,000. There's my PUA payment. But what I'll add here is a portion of the PUA payment is satisfying the term cost. So it's about $180 for the 1-year term cost. So it's minimal there. There's the actual term rider, and it burns off very quick in this example. Here we go. What do I see? 50/50, guarantees, break even when? Year 12, based on the guarantees. When was the 100% base premium? Remember that? Between year 17 and 18. How about the non-guarantees, the dividend? Paid in 100 for 7. Oh, just about year 7, you've paid in 700, you've got 698. Based on the current dividend, the next year you're positive. On a conservative dividend, year 9. Okay. We're going to look at a side-by-side comparison soon. Then we've got the 1090 split. Same thing, guaranteed and non-guaranteed values. Where's the money going? Premium on the far right. We could actually make this a touch lower if we wanted to, maybe between 10% for this example. That buys you a whole life death benefit of $300,000. There's your term insurance rider, target additional benefit. There's the cost of the 1-year term rider. So we put a nice big 1-year term rider on this, and the guaranteed values, this assumes the guaranteed rate only. It also assumes that the company is going to charge the maximum allowable rate, or is charging the maximum allowable rate for that 1-year term rider as well. So it's a worst case scenario. So let's take a look at this. 100 for 7 years. Guarantees. When'd you break even? Between years 8 and 9. With that minimum premium. Look at the upfront cash value. You're at 84% right off the bat. How about the current values, which is based on the present dividend interest rate? About 503. And if you want a conservative dividend, between years 6 and 7 there. So we see no problem here, or which one gives me more money up front, the lower base premium. And this is a specific case. A lot of people like to do this to maximize the internal rate of return, where they will fund a policy between 3 and 7 years, depending on their age and their preference, and then stop. Kill it with a reduced paid up, kill the premium that is. Great method to enhance the internal rate of return. People with sums of cash, they want to get in and say, I don't want to be obligated to make payments. I don't want to have to make payments after I get my money in. This is a popular strategy. So rather than go back and forth with the illustrations, let's take a look at the comparison sheet here. There we go. So we're going to walk through this and I'm going to point out the dividend columns as well. I want to highlight this because this is important. So same product like we just looked at in the illustrations, same out of pocket for you. This is a 40-year-old individual. So pretend that this is you with the 100% base premium example, $100,000 in base. Annual outlay represents what you're paying in. Guardian does not pay a dividend in the first year. First year cash value, $16,741. Exactly what we saw in the illustration. And there's your death benefit. That's the 100% premium example. If I want it, where I've got 50% premium and then 50% allocated toward PUAs to accelerate the cash value growth, what do you notice here? Your out of pocket is the same. Base premium's $50,000. Means the other 50, you've got a couple $100 towards term, the other 50 into PUAs, and there's your cash value, $54,000 and change. Now, what do you notice year 2 about that dividend? $7,400. And how about the all base premium policy? $10,700. This is where some people get confused sometimes, and here's why. I have a higher dividend, but less money, almost $40,000 less. The reason why is this dividend column does not include the guaranteed cash value interest rate, only the surplus. So the dividend does not represent the total growth on a life insurance policy. And in fact, you can see that if I just look at year 10 here, I don't pay anything into the policy. In this example, cash value grows from 701 to 734, yet the dividend, which you'll see this on the full illustration, is about half of that, 15,580 in this example. So where's the rest of the growth? Well, it's in the guaranteed portion. That's where it is. So what I always like to look at, the dividend is beneficial. At the same time, I say, hey, it's good to have this, but I don't really care. I'm interested in the net cash value growth. What did my money actually grow by? Not what was my dividend payout, what was the dividend rate, what did the money actually grow by, and then what's the net internal rate of return. That's what I'm interested in for full transparency. I can relate to that with other accounts or other assets that I have. So 50-50 breaks even between years 7 and 8. 1090. What do we notice over here? right out of the gates, $84,000 and change, 84%. Time passes. Breaking even, just like the illustration. Year 5, paid in $500, you've got $500. Base premium is only $10,000, which also means, by the way, you're only committed to that and the term rider. A lot of people, when we go over different companies and such, if anyone wants flexibility while maintaining the quality of a Guardian life insurance company, one of the 4 major mutuals, we've got proof of performance. They offer a lot of flexibility, so I can commit to that and the term rider. That's all I'm committed to each year. And then at discretion, I can just add more money into PUAs. Then I've got the $100K per year going in, breaking even year 5. Look at the dividend again. Look at that. The lower the base, the lower the dividend. But the lower the base, the higher the net cash value. That's where I'd always direct your attention to. We don't want to fall for a trick, in my opinion, to say, hey, look at the difference in dividends because you get such a greater dividend payout. It's like, I don't care. I have less money. So like, what the heck? Like, who cares about the dividend if it's higher if I don't have more cash value there? So let's look at this long term and see if there's a difference here. How long term should we go? Let's put them at age just before 90, year 50. What's the difference in value? Which one has more? Or I highlight it, you can see it. There's your all base premium. 4.264, 50/50, 466, and then 1090, 4.97, getting close to $5 million. World of difference from start to finish in that particular example based on the present dividend interest rate and the non-guarantees. What happens if we isolate the guarantees here? So like the guarantees we saw in the illustration, now we're going to look at them side by side here. No dividend column here because dividends aren't paid if we're only looking at the guarantees. All base, 16,741, 50/50, 54,000 and change, 1090, 84,155. You'll always notice on a Guardian illustration and actual performance that if I pay the full dollar amount up front for whatever my payment is that year, the guaranteed and non-guaranteed values will match. Beginning year 2, I'll see a difference. Year 18 is my break even based on the guarantees. 50/50, year 12. 1090, year 9. Really between years 8 and 9, there's literally a $9,000 difference one way or the other when I look at those 2 years. Then, as time passes, what do we notice? Go all the way down again. 50 years. Do you see a difference? Yes. Maximizing cash value at the end of the day. So to wrap this up, when we propose different options, right, the question that comes up is, why was I never shown this? The policy that gave me more cash value from start to finish. Because what's the number one source of buyer's remorse when it comes to whole life insurance sales, when people are interested in maximum cash value? They didn't see options up front that they think they would have been interested in if only they were shown at the time. That's the key to properly set expectations and make things transparent. So here we go. Here's the compensation breakdown, 100% base premium. And again, when I was my very early years in the industry, the training I often heard was, long-term, it doesn't make much of a difference for the client, and the base premium policy generates more cash value or generates more compensation. I remember being in a meeting once where the agent at the time even said to a potential client, when the discussion came up about premium and PUA dollars, he said, you know, when we look at it 40, 50 years down the road or long term at age 80, something like that, that there's like a $30,000 difference. Like there's no difference depending on how you design the policy. Isolating that long-term cash value and death benefit figure. However, yes, there is a big difference, since I've learned a lot since then. Since one, actual performance is almost always different from illustrated performance. It's amplified when we look at the all base premium policies. And then 2, when I look at the compensation there, there's a big difference there as well. Nothing against that former agent that I used to work with. I didn't really know anything back then either. But I see the compensation there. Big difference. $83,000 total with the all base premium policy. 50-50 split. $23,000 right off the bat. $52,000 in total. How about that 1090? I don't think I finished my thought before. So the training in the industry will often encourage higher premium products simply because they generate more revenue for the agency, the company, everyone, except for the consumer. That's the thing. So hopefully this helps kind of isolate the issue in the industry, which is really just a lack of transparency. If it was like Amazon, in my opinion, where you could just see all the options up front and select the one that you're most comfortable with as the consumer, that would eliminate a lot of the issues that occur. Just people aren't shown all the different options. When they see this after the fact, they're given some bogus warning to say, well, this option, we don't do it because the policy will mech or something like that. Like, no, it won't. You just have to design it properly. There we go. $29,000 in total comp compared to the $83,000, $50,000 in change. Like, there's a big difference there. And I know I've stated this several times, not taking anything away from agents that sell cash value life insurance. That's how we drive business. That's how we drive revenue for our company. That's our bread and butter, if you want to call it that. So I know that it's a difficult career. And I'm not saying that you should not make money based on your sale. However, if someone's interested in a high cash value product and they're not disclosed that, and you sell them a product that doesn't meet what they asked for, that's where I've got an issue. Like, show them everything. And there's ways to simplify it as well so they don't feel overwhelmed, but it's very important to do that. So hopefully this one was enjoyable. Basically, we just went over why that minimum base premium policy generates a lot more cash value from start to finish for a policyholder based on one particular product. We will progress through more products in the videos to come with different funding periods. If you enjoyed this one, hit the like button, subscribe for more. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.